Good afternoon. This is Tom Alexander. This is the weekend video update that is an addendum to the written report that all of you should have received. If you're not receiving that report, shoot me an email to tom@alexandertrading.com. I'll put you on the list. It's free. You can also go to the website, alexandertrading.com, click on weekend updates, and you will see this weekend's report. You'll see a link to this video. You'll see a link to a PDF that gives charts and gives levels that are mentioned in this video. Also, if you find value in the information, please like, please subscribe. Thank you. Okay. So last week we had this decline that stopped on a dime on Wednesday, had a big bungee jump. It continued into Friday, but Friday was somewhat of a fail from a bullish perspective. We opened up, we gapped up, traded higher, and then closed more or less on the lows in all four of the primary U.S. trading indices. So as we head into next week, basically what we're looking at in terms of important key reference areas, important upper levels, lower levels, will be last week's high and last week's low. Now, as I put in the written report, the indices from Wednesday on, from Wednesday, Thursday, Friday, basically did nothing. Now, there's range there, and there was certainly intraday range, but the net of it was practically nothing. So you can make a bearish case that, okay, we've worked off the oversold condition, and now we're ready to resume the downtrend. Or you can make the case, okay, there's a buying tail in market profile parlance that was put in on Wednesday. That buying tail has been confirmed by higher closes above the tail Thursday and Friday. And now if maybe we put in an intermediate term low, we're off to the races in a seasonally bullish period. Which one is it? I don't know. But as usual, I'm going to let the market decide, and I would encourage you to let the market decide. No one has a crystal ball. No one knows what's going to happen next week, but we can look at levels. We can understand the context of what has happened and what could be setting up. And then once we have that, then we can identify price levels that would validate any assumption that we might choose to have, whether it is a bullish assumption or a bearish assumption. The market has to do something. If the market's bullish, it has to take out certain levels above to validate that. If the market is bearish, it has to take out certain levels below. And it doesn't have to be any more complicated than that. Let's take a look at the charts real quickly. Okay, this is the SPX, and now the levels you see here. I put charts. I was traveling this weekend, so I formed my charts and captured my charts on my laptop, so I don't have the levels on the screen here. But it's not that hard. It's Friday's high and Wednesday's low in the SPX. You can see here, and then let's just move along, and we'll look at the Index. And again, it's Wednesday's low and it's Friday's high. Now, there is a gap that has not been closed above Friday's high, so there's a little room in there. Margin of error. Russell. Now, the Russell is a bigger deal. Friday's high, Friday did close the gap, but above Friday's high, you're sort of in an elevator shaft back up into this range somewhere. Now below Friday's low, and you can see Wednesday's low, you can see the Russell traded into an awful lot of volume on the horizontal scale. If the Russell were to get below this area, it could really portend something very bearish, especially in the very short term. And last but not least, the Dow. And we have Wednesday's low, and we have Friday's high. And those are the levels that you really need to watch going into the week. And another thing about those levels, watch those levels. It's not enough for just one index to break that level. You want to see closes above or closes below the levels highlighted by all four of the indices. Otherwise, it's questionable. But when there is a significant move, all four of the indices will move in lockstep. Now, I realize the correlation thing among the indices, and in the short term, well, in the past year, it has been not as strong as it has been in the past. But when the markets are moving strongly, when there's a strong trend, and you can go back and check this yourself, all four of the indices, when there is institutional sponsorship of a move, everything is going to move together almost to the tick. And unless you see that, I'm suspicious of that move. And that's true across all time frames. Okay, let's take a look at something else. I want to cover this is the profile view. Now I have, and if you go back and you look at previous weekend reports that are on the website, you can follow the progression of this analysis. But we came into a week ago, 2 weeks ago, a very, very mature structure. And I said at that point in time, okay, what you're going to see, what is inevitable is a trade to or through either the upper extreme or the lower extreme of this structure. Well, that's what we have. So what we could be having now is another distribution. And in market profile / auction market terms, a distribution is a range. It's simply a range that gets established. And if that is the case, we're in the early part of a new distribution, which will eventually form an auction like you see on my screen in this time frame. So that's a real possibility. You can look on the, you can see on the quarterly chart here, the next level to the downside volume level is way down here, 4170 to, see if I can grab that. There we go, 4108 or so. So that if we do have some sort of waterfall decline next week, this would be an area that would be interesting to keep an eye on. Okay, let's look at the technical situation. And for technicals, I don't use oscillators, magic numbers, any of the stuff that pivots, any of the stuff that floor pivots is what I'm referring to. Any of the stuff that 99.9% of all traders use, because it doesn't work. What you see on my screen here are moving averages of NYSE advancing issues. The red is a 10-day moving average of NYSE advancing issues. Green is a 5-day moving average of advancing issues. The blue is simply breadth, NYSE closing breadth. Now, we didn't quite close negative 2,000 last Tuesday, but we came close. It was like negative 1958. We did close negative 2,000 on 9/21. So this is something that you typically get, and it's something you want to see at intermediate term lows. Now, that doesn't mean this market is about to rip higher here, because we've had 2 days within a short period of time of negative 2,000 breadth or almost. You can get a cluster of these things in these bear trends. Now, what would be interesting would be if we do see continued selling next week and the 10-day and the 5-day moving averages reach some sort of downside extreme relative to the past couple of years of trading. We have another flush, have another negative 2,000 breadth reading. Then I would be a little more confident in saying, okay, this is what this is telling us is that we have an intermediate term low in place. Could we have an intermediate term low in place even though we're not all that extreme in the 10-day and 5-day? Absolutely. As always, price rules. Price action is what you always default to. Will keep you out of trouble. Always let price action prove or disprove any particular bullish or bearish narrative you have in any time frame. Guys, I hope you enjoy the rest of your weekend. Hope you found value in this. I will speak with you again soon.